over the last few months, I've heard some people mention or comment on how Donald Trump could possibly be at this point in the presidential race. And I think when people ask that question, they're completely missing the point. This week, news came out that the Pentagon, let's call that the government because it is, are asking soldiers who were offered bonuses for signing up for military duty over a decade ago to give back those signing bonuses. I mean, you want to know why Donald Trump is where he is? It's because people hate the government. People hate the policies the government is implementing. And this Pentagon idiot, I mean, what was the conversation like between those two idiots or three idiots or whoever, whatever brain dead person said, you know what we're going to do? We're going to go after veterans who fought in wars. And we're going to go after them and we're going to say, you're going to give us back the money that we gave you, in this case, the California National Guard. We're going to ask for it back. Yeah, oh yeah, Bob, that's a really good idea, Bob. Yeah, because Steve's head is so far at Bob's butt, he can't think anything other than say, yeah, good job, Bob. Yeah, we should go after veterans. You want to know why someone like Donald Trump is where he is? Or where other Donald Trumps are where they are in Greece or France or Italy or Denmark or Holland or Britain? It's because people hate their government. They hate the last 16 years of stupid choices, stupid decisions. And when the government, yes, I'm going to call the Fed the government because the president elects the chairman, in this case, Janet Yellen, that should absolutely be a elected position and not appointed. First of all, we shouldn't even have the Fed, but we'll get to that another day. So you have the Fed, which I understand legally or technically is not a government entity, but you have the Fed that printed in this country $3 trillion. Now, we know that created asset inflation. That helped the top 1% or 2%. Let me go a little crazy and say the top 2.5% of this country, because those are the people who have their money in the stock market and the real estate market. And that $3 trillion absolutely created hyperinflation in publicly traded companies, privately traded companies, and real estate. And so there should be no wondering why someone like Donald Trump, I mean, yes, he's mentally ill, and yes, he doesn't think about what he says, but it's not him per se. It's people saying enough. Now, look, if the government would have taken that $3 trillion and made sure it got to the bottom, let's say between 50 to 90%. So you're at the 50% level of income and net worth all the way up to, say, the 90%. And none of it went to the top 3%. So somehow that $3 trillion got to them. And the interest rates that were dropped to zero, that helped them. Or maybe they increased it for them. But everything the Fed did was for them. And everything that Clinton did to hurt the banking industry at the end of his tenure. That's Clinton number one. Looks like we'll probably have Clinton 2.0 soon. Or maybe that's 3.0 because Clinton, the philanderer, he had 2 rounds as presidency. And now it may be we get his wife, which I often think of as BFL, big fat liar. But this is what we have. This is where we are. Yeah, I hold both of those people equally in contempt. So you wonder why people hate their government. It's because of really, really bad choices consistently for a long enough period. That's why. Hey everybody, this is RC Peck, and this is my weekend podcast. I changed the name of the front page, evidence-based wealth. I like to think that I follow the evidence and see where it takes me. And evidence, you can't have your evidence and my evidence or your facts and my facts. There typically is just one fact. What is the price of Microsoft? What is the price of Apple? Notice I'm not saying what is the valuation or what is it worth, but what is the actual price? And that's why I love looking at price, because it is a fact. There is not 12 different types of price like there is 12 different types of earnings. So where are we today? What's going on? And I want to point out one thing, because there's a very good likelihood that this December, Janet Yellen, for the second time as the chairman, which I think that's a funny title, is going to raise interest rates another 0.25%. Now, she did it back in December. In fact, she announced it on December 16th. And when she did, we have a very good idea and we have a very clean piece of data that we can look at to say, okay, how did things react to that 0.25% increase in the federal funds rate, right? What can we learn from that? And that was the first federal funds rate increase in 7 years. And it was a 0.25%. All right. So here we are. There is probably a 75% likelihood that Janet will increase rates again. The only way I could imagine she wouldn't, which I hope this is not true, is maybe if the market falls 10% between now and December, which, we've got elections coming up. I believe it's November 8th that they actually happen. So there is some chance that things could just get totally sideways and crazy and that she holds off. But as of right now, it's about a 3/4 chance, a 75% chance, a 3 out of 4 chance that she will raise rates. So what I want to do is look at what's happened this last time around. And the reason this is important is because when we had the global financial crisis back in 2008, the world changed. And so we're really living in a new world now. And so this is the first time back in December 16th of last year, 2015, that rates were raised for the federal fund. The federal funds rates were raised. And so let's just look at what happened. I took 3 main assets and then I threw in one fun one. So the first one, just look at this. Silver, after falling for 4 years, went up. And as of today, it's up about 29%. Now at its peak, it was up over 50%. But still today, it's up about 29%. So the Fed raises interest rates 0.25%. And that signals to silver, hey, you know what? We're done falling for the last 4-ish years, and we're going to go up. And here they are today. Here it is today at 29%. Then you've got the S&P 500, the most followed index on the planet, the most important index on the planet, and that's gone up 6.4% over the exact same time period. And you can see here what happened. That was Brexit right there. If you look at the screen, that little dip there was Brexit, and this move up was Brexit. So we're kind of in this post-Brexit world right now. And then you have the 10-year bond, and this is the price of the 10-year bond, not the yield, but the 10-year bond price went up 5.2%. And to me, what's interesting is, generally speaking, the price increase of the 10-year bond and the S&P 500 with dividends included for both of these, they're not much different this year. As you can see, the blue line and the green line, they're up about the same this year. And then lastly, I guess you could call this chartreuse, kind of a pinkish color. The US dollar during this time period is, we could call it flat. Down 0.44%. It's basically flat. So this is interesting. And I want you to really understand this, because you're going to be hearing a lot about what should happen or what things are correlated with interest rates going up or down. And I was on a website yesterday looking up some research, and literally right there on the front page of this website, it says, when interest rates go up, stocks fall. And if you remember my podcast from the last couple of weeks, that's actually not true. And so the amount of misinformation out there, go back to the price, guys. Go back to the price. Price is the fact. Price does not lie. So what's the takeaway? Okay, now this is just one percentage increase. This is just one, 25%, 0.25% increase. It's a one-time thing. So does this mean what we had this last 10-ish, 11-ish months is going to happen again? No, but this is the data that we have. This is the price information that we have. So it gives us some idea of what might be coming. It could mean that, in fact, precious metals have bottomed. The dollar hasn't really figured out what to do. It's been in a sideways channel for about 22 months. And then you have bonds and stocks that are also trying to figure out, should we move higher? Should we move lower? But we do know stocks and bond prices have both moved higher. So that's where we are today. And it is very interesting. And we do live in interesting times. And we can see that by this price chart right here. Okay, so the takeaway. First of all, guys, less really is more when it comes to investing. And the less I'm talking about is when you hear a headline or you get an email from some newsletter person that you don't even know how you got on their list that says if Hillary wins, the market's going to crash 50%. Or if Donald Trump wins, the market's going to crash 50%. And it's very likely that newsletter person sent out, half his emails were if Donald wins, the market crashes, and if Hillary wins, the market crashes. And then he can just see which one's got more clicks, and then he can figure out, okay, that's what I'm going to sell next. So less really is more. And look, here's the thing. Hindsight happens in a moment. It happens in a second. You look back over a year or 3 years or 5 years, and literally in a moment you can look back and go, I know what I could have done differently. It's so interesting how hindsight happens in a moment. And we want foresight to happen in a moment too, but it doesn't happen that way. And then you have the present moment. The present moment just feels like forever. It just feels like forever. Like, oh, I bought the S&P and it's only up 2% or it's down 2%. How come it's not moving faster? Don't the investment gods know I'm now, invested? No. And this is why present moment feels so hard for adults, because you have to stay in right now. And then lastly, and this is kind of about the future, certainty certainly seems elusive. And I'm not actually sure if I spelled elusive properly or not, but nonetheless, there's the word. And the reason the future seems elusive is because our brain strives for certainty. It wants to know that we're going to survive. It wants to know where our next meal is. It wants to know that we're going to have shelter and clothing on our back. And that is the way that our brain has been designed over the last million years, is to strive and look for certainty. And that's why fear-mongering works so well in the pick of the month newsletter industry. Because the moment your brain thinks, wait a second, if Hillary wins, it's going to crash? Wait. If little Donnie wins, it's going to crash? Whoa, hold on. I got to figure this out. What's he talking about? Like the brain, literally the prefrontal lobes go offline and your amygdala absolutely lights up. This is actually what's happening from a physiological point of view. And that's why your brain gets so hijacked. And that's why it actually doesn't matter what your IQ is. You literally just need a basic IQ to grow money. And in fact, there's actually been very clean studies done, peer-reviewed studies that show that people that have damage or that have damaged prefrontal lobes, they actually grow their money better because they don't hijack themselves as much. Whereas people who have higher IQs, they get into this analysis paralysis and they spend hours, days, weeks, or months investigating why they should own something. And they create this bias towards it. So stay the course, stick to the price. We've got elections coming up in less than 2 weeks. After that, in probably 3-4 weeks after that, Janet's going to come out and say, whether rates go up or down. So we have a couple big announcements in front of us, and everything's kind of been on hold, and it's kind of waiting like, okay, let's just see what's going on. So that's where we are right now. We're kind of in a holding pattern, and that is okay. That's the present moment, and that's why it feels so painful, because the present moment feels like it's stretching on for so long. Hey guys, this is just another step in helping you protect your portfolio and your future. Until next time, this is RC Peck. Hey guys, one of the things I talk often about and what I rail against is how there have been many things that have been disrupted by Silicon Valley. They have disrupted almost every industry and idea, from communication to transportation to medical to banking, to cameras, to medicine. Did I mention medicine, right? To energy. But the one thing they have not touched is this idea, this I call it the Wall Street kind of investment platform. And this idea that you need to be diversified and then rebalance. And look, here's the thing, guys. They tell you get some large cap and get some international and get some value and get some small cap and mid cap and throw in some REITs and get some muni bonds in there or some corporate bonds, or it doesn't matter what type of bonds, but you got to get your bonds and definitely get some growth in there. Right? Now, said a different way, it's kind of like get some in steerage and get some in the lower cabin, in the mid cabin, and get some in the presidential suite. But look, if your boat, well, actually, before I get to that, and then you know what it says? It says, hey, and then shuffle the deck chairs. Shuffle it around, kind of rebalance it once a year, because that actually matters. It doesn't. But shuffle the deck chairs around because that really matters. But look, hey, if your boat that you're on, which the majority of people on, which is this idea of diversification and rebalancing, hits something like an iceberg, it doesn't matter if you're in the presidential suite or steerage or the lower cabin, or you've got a patio. I don't even know what they're called, a patio view, a window view, a deck view. It doesn't matter. Everything's going down. What matters most is your approach. And one of the things that I hear most from people who connect with me on the phone is, especially when I do an audit of their portfolio, they see the leaks. They go, oh my gosh, I did not realize the leaks I had. I did not realize the behavior I was using that was hurting me. But in that conversation with that changed everything for them. And literally it was the difference that made the difference for them. And that next step is super straightforward. You just get on the phone with me, you schedule time, we connect, and we talk about that. Thank you guys for being in my world. I love what I do, and you support me in doing that. You guys have a great weekend. Take care.